security markets are divided in two parts. One is called money market, other is called capital market. I'm sure that what we are discussing now, most of you all are quite aware if you're already in the industry, if you're already in this banking or wealth management industry, you would be knowing it, but you can just take it as a refresher for you. So you have money market, you have capital market. Under money market, you have, see what is money market? The market where the securities have a maturity up to 1 year. So the short-term securities whose maturities is up to 1 year are called money market securities. Capital market security, any security whose term, which are having a maturity 1 year and above, they become capital market securities. Okay. So under money market security, you have treasury bills, certificate of deposit, commercial papers, government security. So uh, T bills are basically those issued by the government, treasury bills, T bills. Certificate of deposit is short-term securities which is issued by banks. Commercial papers are short-term securities issued by corporates. Government securities, or you can say RBI securities, some repo agreements and all, repos, reverse repos. So all these are money market instruments. You, where it comes to capital market instruments, you have primary market, you have secondary market. Primary market is that market where the security is issued for the first time. Okay, where you are buying the security directly from the issuing company directly. That is called primary market. So like your IPOs, initial public offering, right issues, bonus issues, uh, private placements. Okay, these things we will discuss more in detail when we talk about equities and all. So you have different issues where you are buying the securities directly from the issuing company. So these are primary market instruments. Secondary market instruments where already issued securities are being listed and they are traded and they change the hands. So from A it is sold to B, B sells to C, C sells to D. So over here the company, issuing company, is nowhere involved. It is only the securities are changing their hands. So that is called secondary market. So you have, under that you have equity trading, you have bonds which gets traded in the secondary market, derivatives gets traded, commodities get traded in the secondary market. So these are secondary market instruments. You can categorize the investment option based on marketability. Instruments can be categorized as marketable or non-marketable. Marketable instruments are those instruments which can be traded, which has a secondary market which can change their hands, and non-marketable security is something where you own a security, you have bought a security, but you are not allowed to sell it to somebody else. You cannot, there's no platform where the instrument can change the hands. Okay, so marketable, marketable securities, where you have treasury bills are marketable. Although we as retail investors may not be allowed to participate in few of the securities like treasury bills, we can't participate. Government bonds, like not all bonds are available to the retail investors. Okay, but just as a nature of the instrument, we are just trying to understand. So these instruments are marketable. Treasury T-bills, certificate of deposits, and other government bond securities. Equity shares are marketable. Preference shares. See, preference shares, again, not all preference shares may be marketable because some preference shares will have some restrictions not to get traded. Then mutual funds, debentures can be traded, derivatives can be traded. Insurance as such may not always be marketable, because in India it is not marketable, but other countries there can be policies which can be exchanged, which are not the pure term insurances and all, but other policies which are like annuity type of policies or any other type of policies which can be marketable. But as such, they also generally comes under non-marketable security, because insurance is basically a individual personalized contract between you and insurance company. So you actually are not allowed to sell your insurance to somebody else. Okay, you have to seek the permission of insurance company, and company may not want you to give it to anybody else, because different people have different type of risk, and company would just not want to allow you to change or give this policy to somebody else. Non-marketable, the bank deposits are not marketable. Post office may there will be certain schemes like fixed deposits, MIS, all the post office deposits, Kisan Vikas Patran, NS National Savings Certificate, PPF, Senior Citizen Savings Scheme, 5-year deposit or recurring deposit. None of these are tradable. Okay, these are non-tradable securities. Then you have company deposits not tradable, PPF account not tradable, RBI 8% bonds. Now I think this has become 7%, 7 or 7.1% or so. So even that is not tradable.
Reach out today and let's do it professionally.